Financial Modeling, Topic 21, Capital Budgeting, Section 2. In this section, we're going to evaluate investments with Capex, revenues, and Opex. So we're going to do an example from that corporate finance book I mentioned in references. It's the Baldwin Company. Baldwin's a recreational company. It's considering capital investment, a Capex expenditure, in a machine to manufacture brightly colored bowling balls. They've already conducted some research. However, that's a sunk cost. We're not going to consider that in the cash flows. The balls will be manufactured in an existing company facility that could be sold today. We're going to consider that an opportunity cost and include that as an initial cost today. The following worksheet has detailed assumptions for revenues, Opex, Capex, and working capital for 5 years. Capex will be depreciated using an accelerated schedule, MAKERS, which is the Modified Accelerated Cost Recovery System. And working capital will be needed today to start this project, but this is going to be a finite life project, so we're going to end the working capital in year 5 and set it to equal to 0. So here are my assumptions. I've already spent 1 year ago $250,000. I'm not going to include that. I'm going to use a facility that's going to cost, or it could have sold for $150,000 after tax. I'll include that today, but I'm also going to try to assume I'd sell it off after the 5-year investment. That machine, that Capex, is going to be $100,000, depreciated 5 years using the accelerated cost recovery. I'm going to resell the machine in 5 years for $30,000. I'm going to price the balls at $20 in year 1. The price will increase by 2% a year. My Opex cost per ball is going to be $10, and due to some manufacturing shortages and supply, that cost is going to increase by 10% a year. I'm going to need initial working capital today of $10,000, and then in the future it's going to be 10% of that year's sales. My net working capital at the end of the 5th year will be 0, and I'm going to use a tax rate of 34%. So my working capital includes cash, receivables, payables, and inventory. So I'll consider cash as a non-interest bearing working capital for this example. So what we're going to calculate is the NPV and IRR using a discount rate of 10% for the NPV. And let's go to the spreadsheet. And before we do that, though, I do want to talk about the depreciation. Now, our estimates of value and net present value use cash flows. So when I use cash flows, I need to understand the actual cash of the business, not the profits. Now, this is important when we talk about depreciation. Normally, when we talk about financial statements, we say we depreciate the cost minus the salvage value of a capital expenditure. However, according to the IRS, we depreciate the full cost. So that's going to be a difference between accounting books and tax books. And since we care about cash only, we're going to just do it according to the IRS. And then if we sell that piece of machine or that Capex, we're going to get some salvage value, and we're going to be taxed on that. So the after-tax salvage is going to be the salvage value minus the tax rate times your taxable gain according to the IRS, which would be, again, that difference between the salvage value, what you sold it for, and the net book value, where the net book value on the year you sell it will be the total cost you paid for it initially minus the depreciation up until that point. Now, for this bowling ball machine, we're going to use a 5-year ACRES, which means instead of just depreciating 20% a year for 5 years, 5-year depreciation is actually going to depreciate things over 6 years, as kind of assuming maybe the first year is a half year. So it's going to depreciate the first year at 20%, then 32%, 19, 11, 11, and 5. So these are going to be my depreciation amounts of my Capex. And you can see there's certain rules about what types of assets are depreciated over, say, 3 years versus, say, 20 years for long-term equipment. And what the reason why we have modified accelerated depreciation schedules is it probably more accurately reflects the use of the machinery. You would think like when you buy a new car and the first year you have it, it's going to depreciate a lot, but then that last year you had it, it's not going to depreciate that much. So it kind of recognizes that in reality, New things are depreciated. They lose their value faster and then slowly at the very end. So let's go to our spreadsheet and calculate the NPV and IRR of this bowling ball machine, this investment by Baldwin. So my unit sales are going to sell 5,000 balls in the first year, 8,000, 12, 10, and 6. My depreciation rates from the schedule will be given. So that's going to be 20% in the first year, 32, 15, 11, 11, and 6. Although I'm going to finish off this project in year 5, this is going to be an assumption that at the end of the 5th year, we're going to close down this business. So here are my revenues. I'm going to sell 5,000 balls at $20 a ball, and so on. So these are my operational revenues. I have my operating costs. I'm going to sell 5,000 balls at $10 a ball. Those costs are going to go up. So I can just go ahead and calculate my EBITDA, take my revenue minus my Opex there, and I got my EBITDA. Now let's take our depreciation. The depreciation per period is going to be the depreciation rate for that year times my capital expenditure. And I'm going to anchor that capital expenditure. So I'm going to depreciate 20% and then 32% and so on. But I'm going to finish it off at end of year 5. So that's going to give me EBIT. Take my EBITDA minus my depreciation, and I have my EBIT. And then I'll take my EBIT after tax by taking the EBIT, multiplying times 1 minus my tax rate, 34%. Anchor that tax rate. And I now have my EBIT after tax, which is also called the NOPAT, net operating profit after tax. Now, net working capital is a little bit interesting for this project. We're going to make the assumption I need $10,000 today just to get this project running. Then it's going to be 10%. I'm sorry, where is that net working capital? Yeah, 10% of that year's sales. So I'm going to put it in here, the sales in year 1 times my net working capital percent of sales, anchor that. However, I'm going to make the assumption, since this is a finite life project, we're going to close out all the receivables, close out all the payables, sell off the inventory, and bring the cash back to the company. So I'm going to say the net working capital at the end of the year 5 is 0. So these are my net working capital amounts starting today and ending in year 5. Now, and these will vary. The assumptions for working capital will vary. Sometimes you might say, you know, I'll just need the working capital by the end of the first year, so it might start off at 0. And sometimes, if the project is going to live on past your investment horizon, in other words, this is a 5-year investment horizon, if I assume this bowling ball machine would continue into the future, I would not zero this out. But since this is a finite life investment, we're going to shut it down, sell off the machine. I'm going to put 0 right there. Let's also look at the net book value of our Capex. I'm going to buy that machine, and initially it's going to be worth $100,000. However, each year I'll reduce that amount by its depreciation. So by the end of the 5th year, that machine is only worth $57.60. So let's now calculate our free cash flows. I'm going to start with my after-tax operating profit. I'm going to add back my depreciation. I'm going to take out that Capex, that actual cost of the machine. The cash cost of that machine was $100,000 today. However, I'm going to get, at the end of year 5, I made an assumption I'll get $30,000 for it. However, that's a pre-tax amount right there. So I need to pay taxes on that $30,000. So I'll take that amount and I'm going to subtract the tax rate times the taxable gain, which is the $30,000 minus how much it's worth according to the IRS, $5,700. So the difference between those two numbers is the taxable gain. So I'm only going to be able to keep $21,758. So again, that is my $30,000 minus the tax rate times the difference between $30,000 and the net book value. This is the gain according to the IRS. Now this problem has a unique situation. I'm going to assume they're going to use this existing facility that could have been sold for $150,000, but they didn't sell it. They're going to wait 5 years to sell it. Now, I could have made an assumption that the building's worth more than $150,000 in 5 years, but I'll just assume they delay the sale and it's worth exactly $150 5 years from now. But it'd probably be a more reasonable assumption that that's probably worth a little more in the future. Now, the change in net working capital, it's going to go from 0 to 10,000 today. And now the change in net working capital annually, however, is going to be the change between that year and the prior year. So what you see is net working capital does not grow the first year, and then in the last year it all comes back. So these are my unlevered free cash flows. I'll copy that across. And now I'm ready to calculate an NPV and see if this project's worth doing. So what we'll do is we'll calculate the NPV, which I have right here. So the NPV is going to use the discount rate of 10% and then use these cash flows in the NPV formula. And then I'm going to add back the initial cash flow because NPV assumes the first cash flow is received in period 1. So I need to come back and add that number. So the NPV of this project is $51,590. And if I take the IRR, it's $15.68. So this is looking at a 5-year finite life project, isolating the free cash flows or computing the free cash flows and calculating the NPV and IRR. So I would indeed do this project. I only demand a 10% rate of return based on the risk of this project. The project gives me a 15% rate of return. Another way of saying that is it creates $51,000 over of value. So I'm going to do 2 more projects to invest or to evaluate. So say a particular company is launching a monthly digital marketing plan that's only Opex. So how can I do an NPV of an Opex project? So you're considering the launch of a 1-year digital marketing plan. The following worksheet computes the free cash flows and computes the NPV and IRR of the investment. So let's go to that spreadsheet. Notice I have most of the stuff filled in for you. So here are the assumptions. You're going to spend $30,000 a month for 2 months to kind of get to build this digital marketing plan. And that's that $30,000 for the first 2 months. I'm then going to spend my digital marketing spend per month is $25,000 a month. For the next 12 months, that will take me out to month 14. And I've estimated that that $25,000 will generate $45,000 in revenue. However, the cost of that revenue is going to be $13,500 per year. So here's my EBIT of my digital marketing plan. It's going to cost me $30,000 in Opex for the first 2 months to develop this plan. And then my net EBIT is going to be $6,500 a month for the next 12 months. I then take that after taxes. And I just have an assumption that net working capital, I have an assumption here that net working capital is equal to 8% of sales, and it starts in month 2, and it's based on the next month's sales. So my working capital goes to $3,600, but then I liquidate it at the end of the last month. So it's going to cost me $3,600 of working capital at the end of month 2, but then it comes back at the end of month 14. So finally, I have my free cash flows, my after-tax EBIT. I don't have Capex or depreciation in this because there's no capital expenditures. So these are my free cash flows for this Opex project. I then calculate the IRR of those free cash flows. So this is the rate of return on those negative investments today. However, this is a monthly rate of return since these are monthly cash flows, so I'll multiply that times 12. So it's got a 42% return, not too bad. And I'll do my NPV, where I put my annual discount rate divided by 12 to have a monthly discount rate, and then put in all the future cash flows. And since this starts in period 1, I can just start with the first cash flow. So this project has a 42% IRR and an $8,000 NPV. We should go ahead and do it. The last project is Walmart. Walmart maybe is looking at launching in-store banks. So they're considering the launch of small banks in each superstore The following worksheet will compute the annual cash flows, NPV, and IRR of the investment. We're going to assume this is an infinite life project, so what we're going to do is we're going to add some terminal value at the end, and we're also going to probably keep working capital going and not zero it out. The banks will reduce store merchandise sales due to the use of existing merchandise shelf space. So that's going to be kind of a cannibalization of sales just because of less shelf space. But they're also going to drive more merchandise sales due to increased banking foot traffic. So we're going to account for the cannibalization and sales creation. And then a preliminary market analysis has been completed for $1 million that provided the following estimates. And net working capital starts in year one and is a percentage of next year's sales. So let's go to the spreadsheet. Just has a few items we need to complete. So here's my Walmart bank. It's going to take 2 years to get up and going. My Capex is going to be 1 year from now. So here's a common thing. Normally I'd have Capex today, but if I'm actually evaluating a project, it's probably going to take me a while to actually build that store or even get the plans and say even just architectural plans or forecasting plans and get contracting done. So this project, 1 year from now, I'll start building a store. 2 years from now, that store will start generating revenue. So here's my revenue per year. I'm then going to have cost of goods sold, assuming it's 60% of revenues. I'm going to have my depreciation, which is going to be 1/10 of my Capex, since I'll do a straight line depreciation. I'm going to assume that I lose $50,000 in Walmart Superstore because of loss of the shelf space. But I'm going to generate an extra $40,000, and that grows a bit because there's just going to be more people coming to the store to do banking. So here's my EBIT, revenue minus Opex, including depreciation. I'll take my EBIT after tax. I'm going to add back my depreciation. I'm going to take my Capex, we'll start 1 year from now. And then I have my net working capital. So let's come down here and get net working capital. Net working capital, let's just assume that's going to be some percentage of the following year's sales, and that percent is 20%. So I'm going to anchor that. So this is my net working capital. So my change in net working capital, I don't need any today, but a year from now, I'm going to need $40,000, and then it grows basically with sales. And it doesn't zero out. Notice it does not zero out and come back. I now can get my free cash flows by taking my after-tax EBIT, add back depreciation, subtract Capex, and subtract changes in net working capital. I'm going to do something here, and since this is an infinite life project, we'll assume these banks stay inside the stores forever. I'm going to calculate a terminal value. So I'm going to do this. Normally there's two ways to do this. We can either do an EBITDA multiple. I can assume that the banks are worth some multiple of EBITDA, or I can just do a growth perpetuity. Let's just do a growth perpetuity. Let's assume that those banks can generate this cash flow in year 6, and that cash flow will grow at 1% forever. So now this number here will be the year 6 cash flow times 1 plus the growth rate. That's now the year 7 cash flow. I'll divide that by my discount rate minus the growth rate. That's a growth perpetuity starting year 7 and going to infinity. The value of that perpetuity starting in year 7 and going to infinity is worth $1.2 million in year 6. I'll add that to my year 6 cash flow, copy that across, and now I have my free cash flows. I'll now calculate the NPV of those cash flows equals NPV, put in my discount rate, comma, first cash flows start 1 year from now, so I can just start right there. And there's my NPV of $490,000 per store. And I can calculate my IRR. Now, here's a weird situation. When you have a growth perpetuity in your valuation, you can't use IRR to calculate, you can't use the IRR function to to calculate its IRR. So, and that's because the discount, you can't just use IRR because the use of the growth perpetuity is going to mess up the IRR calculation. So let's do it this way. Let's get rid of this. Let's do data, what if, goal seek. Let's set the NPV to a value of 0 by changing that discount rate. Turns out to be 13.95%. I'll cancel and put in 13.95%. All right, so the reason why you can't use the IRR is because the discount rate is in this formula also. So the IRR function is not smart enough to change this one while looking at these cash flows. So my IRR of this project is 13.95. So in this topic, we calculated 3 different NPVs and IRRs of 3 different projects. Now, all of these turned out to be positive NPV projects. So the first one turned out to create value of $51,000, the second one $8,000, and the third one $490,000. In theory, these increases, these NPVs should immediately make the firm more valuable, equal to that NPV. And if this is a public company, it actually should increase the stock price. If I just take the NPV divided by the number of shares, that should be the increase in the stock price. Now, of course, this is a theoretical value. The only way that the stock price would actually increase is that investors are more motivated to buy the stock and bid up its price. So what you need to do is tell the investors your new plans, and hopefully they'll incorporate that into their forecast of your free cash flows and bid up the price of the stock. So in this topic, we evaluated investments with Capex, revenues, and Opex.